Hey guys, I wanted to take this opportunity to remind you all to like and subscribe. It really helps me to keep getting the best guests onto the podcast. So I really appreciate it if you did. And now onto the video. And one of the things that a lot of people have been worried about is treasury yields could possibly go negative if COVID-19 continues. And one of the things you've talked about is now that we have low yields, the impact on the dividend discount model has been that the risk that the model assumes is lower because yields are lower, and this in turn gives a higher price or a higher value for companies. So what do you think is going to happen if yields end up going negative? And do you think they will go negative?
Okay, so if you think of Microsoft, Netflix, these big tech stocks, the higher quality ones, especially like Microsoft, are very similar to bonds, right? So you have an incredibly valuable company with high credit quality that pays a dividend. You have a company like Microsoft, Netflix that have cash flow, and the net present value of those cash flows in a deflation certain world, so if you have deflation that is certain for 5 years, those cash flows for tech stocks are worth a lot more. And so that's where you get into terminal value. And so in a world where interest rates are rising and inflation expectations are rising, Microsoft stock is unchanged since July 3rd. And meanwhile, Caterpillar is up 25–30%. A lot of the main, the IWM, which is the Russell 2000, a lot of the oil names are up 30%. So you have cyclical companies that are outperforming Microsoft by 30% since July. So that's like July, August, September, October. That's 4 months. That's massive things are going on there. Microsoft's not down a lot. It's flat. But what's going to happen if you go into a real reflationary world next year, companies like Microsoft and Netflix and the cloud space, companies that commanded a 30 times multiple in a massive price to book multiple, in a less deflation certain world, in a world where deflation is not certain, where reflation or inflation is certain, those net present value of cash flows that Microsoft's producing over the next 5–10 years, those cash flows are worth less in a inflation or reflation mode. Whereas to your question, so in that environment, in a negative yields world, and not in that environment, but in the opposite environment, in a negative, companies like Microsoft to be worth a lot more because the net present value of their cash flows in a deflationary environment with negative yields, I'm talking about negative yields, not negative real yields, will be worth a lot more. So we have COVID now. So the last 10 years, I want you to think about this. So in 2011, we had the sequester, which was Republicans took control of the House and they put spending controls on the White House. So they forced the White House to take the deficit from like 1.2 trillion to 500 billion over like 3 years. So that had a tremendous impact on the dollar because that's a massive amount of fiscal spending that's coming down. Then you had the taper in 2000. So that's right there, deflationary. The first. Then you have the taper. The Fed was doing QE1, QE2, QE3. It took like 6 months. I talked to multiple Fed governors. They took like 5 months to really get the PR right on the taper. They wanted to announce it as softly as possible, and they still blew up the emerging markets. The dollar ripped higher because when you look at what the Fed's doing relative to the other central banks in the world, that the Fed is tapering and that's taking down QE. Well, all taper means is if you're doing 60 billion a month of QE and you're promising that out into the future, and then all of a sudden you say, oh, we're going to take it down to 40 billion a month of bond buying, that has a major impact on the dollar, and that was a big negative. It's very deflationary. So you had the sequester in 2011, 2012, 13. They worked their way into the taper. 2015, you had the China deval because of the strong dollar. So there's a massive problem with the dollar strengthening. 2016, we had the Brexit.
Right.
And then 2017, 18, we had trade wars. So the point is, and then 2020, we had COVID. So the point is, if you think back, we have had one perfect storm, going back to 2011, one perfect storm for deflation after the next. Every one of those things was deflationary. The sequester, the taper, the Brexits, the trade wars, everything was deflationary. And so in that kind of environment, if we go back into a COVID that is really bad, with a Congress that would limit the spending, we would go back into that deflationary world. But most likely with the 19 probability channels in the vaccine front, and with the Congress that is split, but still in COVID, we're still going to spend. The probability of negative rates the next 6 months is pretty low because you've got a much more reflationary world and a weaker dollar. You've got real fiscal spending in the planet, and you just have much larger deficits now than you had. So in that environment, tech stocks are in trouble, and value stocks in emerging markets and developed market equities like the UK and Japan will do better than the US. Where the US will do really well is in a deflationary QE environment, which we saw over the last decade.
Got it. So another thing that's on my mind was when you talk about yields. So if the Fed let yields go negative, the banking system is in trouble. And if it goes way too high, you're going to see a massive amount of defaults because of the amount of debt that's in the system. So, what happens if we stay at, say, 0% for too long? And do you think that, eventually the Federal Reserve will have to resolve to some form of yield curve control? Because if yields go too low or too high, they're both sides of the same coin, which is disaster.
Yeah, so since Lehman, they're running out of bullets, right? They've done a ton of QE. They've increased asset prices. They've increased inequality. We're getting to the point where, young people around the world can't afford homes, right? Because the Fed is artificially increasing, not just the Fed, central banks around the world are all artificially increasing the value of real estate and home, what's called household development, household formation is at scary, ugly levels. Young people are not buying homes. This is also deflationary. In the 60s, 70s, and 80s, 90s, buying homes on a percentage basis of the population was much higher than this today. It's because of central banks. So the Fed is really, this time around, they know that they really need fiscal help. So that's why they're begging for it. And I think politicians also understand that central banks, much more now than they did a couple of years ago, understand that central banks can't do everything. So by holding rates too low, too long, you definitely create another Lehman Brothers, you create inequality, you create a lot of bad things. And so the Fed most likely, if this, we in near term, we've got some deflation risk because we have, we're not going to get the fiscal large until the first quarter. We've got COVID ramping up. We have a contested election. Trump thing could get ugly in the next couple of weeks. Biden might still win, but Biden probably does win, not mine. But it could get ugly. So there's some near-term deflation risk. But over the next year, the most likely scenario is the Fed. They're promising that they don't want to. They basically said everything they did from 2008 to 2018 was wrong. They hiked they basically admitted they've hiked too early. They took Trump's tax cut, the tax cut, which is $1 trillion. They literally lit that on fire with rate hikes. They obliterated it. They didn't give the economy a chance to create any inflation. And so now they're basically saying we're not going to hike rates until they see the whites of inflation's eyes. They've created this whole new doctrine. They've admitted publicly that there's risks around social unrest, around inequality. So the most likely scenario is that the Fed comes out of this a little early and starts to taper before 2023.